Welcome, everyone. This is Bob Clustis. I am president of All Star Financial and want to welcome you to the fourth quarter 2012 webinar entitled The Turning Point in 2013, Do We Restore Growth or Return to Recession? We've talked about that a number of times in the past, but want to really focus on the fact that there's a lot of things that are out of our control. Number one of those is really the volatility that we're seeing. What goes up must come down is a question mark, and that is truly the case in 2012 as we focused for you on really trying to minimize as much as we could the volatility, albeit very inherent in our market today because of all the uncertainty. In the first quarter, you saw the market just shoot up with good news on the euro debt situation. Coincidentally, it went down in the second quarter on bad news with the debt situation in Europe, and then a little bit at home. And then the third quarter went back up 6 to 7% on the monetary easing and the stimulus packages that came out. And then in the fourth quarter, relatively flat. And it's really always been our mantra that it's not how much you make, it's how much you keep. And I have to tell you that we certainly lived that by reducing risk and leveling off the volatility this year substantially. We took chips off the table earlier in the year and reduced our exposure risk by somewhere between 10 to 20% on everybody's portfolio. So when we look back and we kind of look at that market review, there really were three things that created a lot of this volatility. Number one would be fiscal policy. Number two, closely behind, is that monetary policy, and then politics, as we all know. The continued uncertainty in all three of these has created the volatility that has been astronomical from a standpoint of managing money in these types of times. Hurdles that we had to navigate kind of going through that in a market overview. We had the European debt crisis, as we talked about. They were climbing out of a recession. And actually, even though still in a recession, the market was up. So that was a hurdle that was anticipated, yet really the market actually gave it a positive showing for the year. The Chinese hard landing, there were thoughts that we might have a recession there, but with new political leaders and expansion internally, we really had a lot of positive things, and the market really took off. And then we have the U.S. political standoff, where we have obviously the tax policy settled now, but our long-term fiscal imbalances we're still trying to tackle as we go here. So when we kind of continue to talk about uncertainty, the U.S. economy comes to mind. Third quarter, we had GDP that was positive. We're going to find out very soon what the fourth quarter was. But we still have unemployment that's high. We still have business spending that's slow. We still have corporate profits that are leveled off. But on the positive side, we do have some things that will create, I think, momentum in the economy. The Fed is keeping rates low. Quantitative easing continues, even though this is an artificial way of increasing economic activity. At $85 billion a month that's being thrown into the equation by what's called an Operation Twist for Treasury bills, where they're selling long-term treasuries to themselves and buying long-term debt with that money. Mortgage-backed securities, obviously that $40 billion a month program there is helping the housing market with rising prices lately. And local government revenues, they have started to improve and will bode well for the economy as we're going forward. So looking forward, there really is no crystal ball that we can see very clearly in. We have the compromise in the tax policy was positive, but the fiscal policy is still uncertain, as we talked about. Fed pumps money into the economy, but that creates an inflation concern. Corporate cash is high, but the economy is still uncertain, so they're basically keeping those in the corporate coffers for much longer than what we had thought originally. And then fiscal policy is again what we have to get in order so that they can spur on the spending as we go. Governments around the world really helped the global easing monetary-wise, where they spurred the bond market off, certainly with a lot of the easing and the inputting of money into their systems. High yields in emerging markets rewarded probably the most, as we saw high yields go up about 3.3% and emerging markets about 1.1%. All other bond markets were relatively flat. Looking forward, when we look at the 30-year secular trend of decreasing interest rates, this bond rally really can't last forever, and that's something that we want to talk about. In the near term, however, we think rates are going to be steady, that we don't foresee high interest rates at least through 2013 and into 14. High yields are still a good bet, as are floating rate bank bonds, which really give competitive yields right now, but also it fights against that potential inflation that we have with all the money being thrown into the economy. Emerging markets and the bond side, again, remain strong. A lot of that is because of the faster growth to their economies with the demographics that they have. And the challenge really will be when rates rise. When that happens, though, is anybody's guess. When we look at the domestic stock market, we can see that it's been challenging times, but the market held up. We saw election uncertainty, we saw fiscal cliff scare, we saw basically all of the uncertainties that created fear in the market, but the results were not too bad. We saw Russell 3000 at a 0.3% rate of return for the quarter, which we feel was good relative to what was going on. Large caps underperformed slightly to the broad market. Small caps outperformed, which is, again, a good scenario based on people's thoughts that the economy will grow. Small caps always come out early and faster. We saw value stocks outperform growth stocks by a significant margin, and that was really due in large part to technology and telecom with weaker spending. Financials, however, did outperform the market at about 5.1%, which, again, was based on a lot of the monetary policy and the mortgage-backed securities being issued into the economy. When we look at the market going forward, the total market really we believe to be fairly valued. That fair valuation, I think, is as a result of pretty decent rates of returns this year, with expected improvement towards the tail end of 2013 return-wise. We have corporate balance sheets that are very strong, and to the point of about $1.7 trillion in cash, which we believe will bring mergers and acquisitions back to the forefront. For the first time in quite a while, we saw international stocks outperform, while European stocks were up over 7%. Even though that they're in a recession, people kind of went out there with bargain hunting. Japanese stocks climbed about 5.8%, and again, based on some new political leadership and the hopes that they're more pro-business with their agenda, help those stocks climb. But one of the things that we have to talk about, too, is that both of these countries, the European nations and Japan in its whole, pay higher dividends than in the U.S. market. And in a global world that we are in, people are looking, obviously, for more dividends as we go. Emerging markets still did very well, too, at 5.6%. China led the way, as we spoke of, over 12%. The tiger nations around Japan, excluding Japan, would be Singapore, Malaysia, Hong Kong. Those countries did about a 5.7% rate of return, with Latin America following up at about 4.3%. So again, the international markets really did well for us. Looking forward, we'd like to say that the faster growth will be the key, and the emerging markets will still be the most attractive. With their younger demographics, their expanding workforces, their lower government debt situation, the European situation showing signs of recovery as we speak. Debt is somewhat probably halfway solved there, but it's still in progress. But the recovery, we believe, is coming soon, as other people have believed over the last quarter when they bid the market up pretty substantially. In addition to that, when we look at kind of a summary, we're really at a turning point, and we've talked about this before, but, in the fourth quarter, market was not spectacular, but it was resilient. We were able to, in all four of our portfolios, outperform the market, and we did that with, again, less risk. They were up somewhere between 1% to 2%. Tax policy is certain today. We know that the pundits in the D.C. were able to get that done. Now let's focus on the fiscal policy, which we believe to be the most important and a work in progress. The 30-year bull market, again, we believe it's going to come to an end, not necessarily as quickly as some people think. Controlling risk is still going to be the key, and holding steady for now is really our answer to what are we going to do in the first quarter. We may make some changes, but based on our belief of getting more conservative last year to the tune of 10 to 15% more conservative than what was normal, we're willing to stay here until we see a little bit more what's going to happen with the fiscal side of the equation. On the fourth page of our newsletter, we want to kind of focus on what we can control, and that's really your financial plan. Many people really get anxious when the fiscal cliff and all of those pieces of information are talked about so frequently, to the point where they kind of get into a mode where there's common mistakes that people make just because of fear. One of those is the psychology of losing. It's proven that humans, the aversion to loss is twice as powerful. So a lot of times we have a tendency to avoid losing, which is not letting us basically invest the money the way we need to build and attain our goals. What we call a recency or present bias, there's again, human nature says that you kind of convince yourself that when things are tough, things will be always tough, and when things are good, things will be always good. That's obviously not the case. And then there's that herd mentality as a result of the natural fear that we just talked about of losing and our failure to see past the current situation, that recency predicament, that too many people buy high and sell low just by virtue of what everybody else is doing. What we'd like you to think about and focus on is really ultimate goals and themes that can benefit you long term, and that's going to be dividends. Buy what is a given. We know the kind of dividend that stocks pay. Let's buy that at the first of the year, and we can have a jump start to the rest of the year. Demographics. You got to buy around the world where demographics are going to push the economies forward, and as we've talked about, that's the emerging side of the equation. Diversification is really, really important, probably as important as it ever has because of the severe volatility that we've had. And last but not least, the disciplined investment process needs to be there consistently, and it has to be basically the backbone of how you manage money going forward in these volatile times. Again, we want to thank you for your continued trust in the All-Star team. Remember our referral program. We had last year about $40 million of assets that were referred to us by clients like yourself, so we really appreciate that. And we want to welcome Tricia Downing, as you can see here on our All-Star Financial Contact. She is our new executive assistant. Tricia grew up in Grand Rapids, Minnesota, and worked in the healthcare or the childcare business for about 18 years. And we're excited to have Tricia and her energy here replacing Valerie. So again, thank you. Have a great day. And as always, be blessed and be a blessing.